Scott Bauer, you've looked at the VIX to give you certain signals. What does it tell you right now? We're still above 30. We're down today, but what is that message that you glean from the volatility or fear index?
Yeah, I mean, the VIX hasn't moved, Liz. You know, everybody's looking for a 40 print to signal some sort of capitulation. We haven't even gotten close. You know, we topped out really around 35 or so. So that imminent fear is really not there. The VIX is elevated because, you know, we are seeing the S&P move, you know, a couple percent every single day. So it's justified to be around 30, but we haven't seen that capitulation. But I really think that, you know, the market has to look at the inflation and also the interest rate environment and not at earnings. Earnings are rear view. Unless someone comes out, you know, IBM did come out and, you know, gave a good forecast, but unless they come out and give a forecast, earnings are rear view. What is here and what we know, at least in the next quarter or two, is that inflation is probably not going down very much and rates are going to continue higher. So if you're looking at the two here, I'd love to say that earnings are going to bail us out. I don't think that's the case.
So Scott, now we're looking at the housing market, certainly, and here's another hot point where existing home sales fell the most, and they look pretty bad over the past 10 years, at least what we saw today. So where do you really go into the money if you're just itching to put some of that cash to work and you don't want to wait?
So, Liz, you know, going back to what you were just saying, I think of all those dynamics, of these overhangs in the market right now, the one that is the most concerning to investors and probably to the market is the Russia-Ukraine situation, because we've been through other cycles, economic cycles, due to, you know, inflation, but not because of a cause like this. So to me, that's the biggest uncertainty. And until that is rectified, I think we're going to have this high volatility environment. Now, where would I go here? Yes, even with rates still ticking up here, I would look at some of the big cap tech stocks, the Apples, the Microsofts, the Alphabets. I think those are actually safer plays. Yes. Do they have a little downside if rates continue to go up? Yes. But I really think that that's where you're going to be in somewhat of a safe haven over the next 3 to 6 months, with a lot of appreciation to the upside when the dollar pulls back, when the Fed, you know, finally tops out here. That's where I would be.
Great to have you both. A very jam-packed hour here. Teddy, Scott, great to see you once again, and we're looking at the dollar, which today is slightly weaker against 3 of the 4 major currencies to which we compare it.